Welcome to Iron Financial, where we forge stronger portfolios and we cut through market weakness. Today, we are hammering into a major paradox. A company reports an absolutely record-breaking quarter, and what does Wall Street do? It slaughters the stock. We're talking about the commercial real estate titan, CBRE. Now, the market is screaming that there's a tectonic shift underway, a huge one, driven by artificial intelligence. But look, our job isn't to listen to the screams. Our job is to analyze the structure, to check the foundation, and to determine if this is a demolition in progress or a skyscraper that's just gone on sale. So let's get right into it. Okay, let's start with the hard facts, the steel beams of the whole operation. In the fourth quarter of 2025, CBRE posted revenue of $11.63 billion. Now that's up nearly 12% year over year. You have to understand, in this kind of environment, for a giant like CBRE, double-digit growth isn't just good, it is a raw display of market power. This is the kind of number that should, by all accounts, inspire absolute confidence. It's a rock-solid top line showing that the business is firing on all cylinders. And you know what? It gets even stronger as we move down the income statement. Their core earnings per share, and that's the number that really measures the operational muscle of a company, it hit $2.73. Now, the Wall Street analysts, the so-called experts, they were projecting $2.68. So this isn't just a beat. This is a powerful, decisive blow that absolutely smashes expectations. What you're seeing is a company that's not just growing, but it's accelerating. It's executing flawlessly. So you've got a revenue surge and a massive earnings beat. The picture here should be crystal clear, right?
Okay, hold on. If the numbers are so strong, if this foundation is so solid, then you have to explain the carnage you're looking at right here on this chart. This is what the market did with that rock-solid news. And this wasn't just a little dip, it was a bloodbath. CBRE plummeted 12%. That's its biggest single-day drop since the entire world shut down for the pandemic back in 2020. And this wasn't some isolated incident. The fear was contagious. Look at Cushman & Wakefield. They got hit even harder, down 14%. JLL fell right in line, also down 12%. You know, Bloomberg didn't mince words. They called it an AI scare trade. So the lead analyst here sees a fortress, but the market clearly saw a house of cards, one that was ready to be blown over by the winds of technology.
And this right here is the central question for every single investor watching right now. What is the disconnect? It's a massive paradox. On one hand, you've got the best quarter in the company's entire history. On the other hand, you've got the worst stock performance in years. This forces us to ask a really tough question. Is the market seeing a deep structural crack in the foundation that these backward-looking numbers just can't capture? Or is Wall Street just panicking, selling first and asking questions later, completely spooked by the ghost of AI? That is what we are here to figure out.
All right, let's break this down. We are going to build this case from the ground up, piece by piece. Before we can even begin to understand the fear, we have to respect the force of these earnings. The market's reaction, it was based on a narrative, right? A story about the future. I want to focus on the facts, on the tangible results the company just delivered. We need to measure the strength of the existing structure before we can even begin to assess any potential earthquake.
Just look at this structure. This isn't just one strong pillar we're talking about. This is a fully reinforced framework. Revenue, like we said, up nearly 12%. But now look at core EBITDA. That's earnings before interest, taxes, depreciation, and amortization. You should just think of it as a pure measure of the cash that the company's core operations are generating before the accountants get to it. And it rose an incredible 18.6% to $1.29 billion. Then core EPS, up 17.7%. We are talking about synchronized double-digit growth across every single critical metric. These are the load-bearing walls of the company, and based on this report, they are thicker and stronger than they have ever been. And get this strength isn't just coming from some obscure corner of the business. No, this is coming from the engine room of the company. Global leasing revenue shot up 14% to a new quarterly high. Just think about that for a second. In a world that's supposedly so worried about the future of commercial space, leasing is hitting records. U.S. property sales surged an incredible 27%. Mortgage origination up 18%. Even the more steady valuations business grew a healthy 9%. This is a symphony of performance. Every single part of the transactional engine is firing on all cylinders, proving that demand in the real world is incredibly robust. And hey, you don't have to take my word for it. This is the man in charge, CEO Bob Sulentic, stating it in no uncertain terms. Highest levels ever for CBRE. This isn't just some analyst spin. This is the view from the command center. The operational performance is simply undeniable. The results are historical. The foundation, based on everything we can measure today, is solid granite. So why the panic?
Because a solid foundation doesn't matter one bit if an earthquake is coming, and the market is betting that AI is that earthquake. We're talking a magnitude 9 tremor that's ready to shake the entire brokerage industry right down to the ground. This isn't about Q4 2025. It's about Q4 2030. The sell-off wasn't a reaction to the earnings report. It was a verdict on the company's entire business model in the age of intelligence.
The narrative that spooked investors is, well, it's terrifyingly simple. For decades, brokers have been the gatekeepers of information and relationships. The fear is that AI is going to disintermediate them. That's a fancy word for cutting out the middleman. Think about it. Why pay a team of brokers millions of dollars in commission when an advanced AI can generate leads, analyze every single piece of market data instantly, underwrite a property, and automate the sales process? This is the existential threat. This is the crack in the armor that everyone is so worried about. The market is asking a very simple question. What is the broker's value when data is free and intelligence is artificial? And that is exactly where the market is profoundly, fundamentally wrong. This is CEO Bob Sulentic's direct rebuttal, and it gets right to the heart of the misunderstanding. The market is mistaking a screwdriver for a wrecking ball because it fundamentally misunderstands the scale and the complexity of this work. They think this is about clicking buy on a website for a 2-bedroom condo. Sulentic is making it crystal clear. This is a different universe. We are talking about billion-dollar corporate headquarters, global logistics portfolios, incredibly intricate sale leasebacks, deals that can take years of strategic planning and human intuition. So the crucial point is this. CBRE's transactional business, the very part the market is so afraid of, is protected because it's not about data alone. Data is a tool. It's not the product. The product is judgment. It's the creativity to structure a deal that no one else has even thought of. It's the strategic thinking to advise a Fortune 500 company on its entire 10-year real estate footprint. Look, an AI can process data, but it can't look a CEO in the eye during a really tense negotiation and build the kind of trust that's needed to execute a multi-billion-dollar transaction. That is the moat. But this isn't just about playing defense. A weak argument is just saying, oh, AI can't hurt us. The truly powerful case, the ironclad case, is about flipping the script entirely. The very technology that the market fears isn't a threat at all. It is the single biggest opportunity that CBRE has. In fact, you could argue it might be the greatest tailwind in the company's entire history.
And this right here perfectly illustrates the paradox. The market sees a threat. AI is going to replace brokers. We see the reality. Every single AI model, every cloud service, every large language model that's being trained right now requires immense, almost unbelievable computational power. And that power doesn't live in some magical cloud. No, it lives in a very real, very physical, power-hungry building called a data center. The AI revolution is a real estate revolution. And guess who the global leader in finding, building, and managing that real estate is? It's CBRE. This is the number that just shatters the market's fear narrative. CBRE stated on their earnings call that they expect their specialized data center solutions business to bring in a staggering $2 billion in revenue in 2026. Let me repeat that. $2 billion. This isn't some side project or a little startup incubator within the company. This is a core pillar of growth, and it's expanding at a blistering 20% per year. The AI boom is literally being built on foundations that CBRE finds, develops, and manages. And let's be clear, this isn't some far-off future promise. This is happening right now. In 2025, work related to data centers and digital infrastructure already accounted for approximately 14% of the company's entire core EBITDA. A significant portion of their profit is already being generated by the AI gold rush. So while the market is panicking about a hypothetical ghost in the machine, it is completely blind to the massive, tangible tailwind that is already padding the bottom line. Okay. Let's accept that for a moment. The core brokerage business is defensible, and there's a huge, undeniable AI-driven tailwind from data centers. I'll concede those are strong points. But the market is always looking forward. So can they keep this momentum going? What does the blueprint for the future actually look like? A great quarter is history. What does the guidance tell us about the road ahead? It looks like this. Confidence. Pure, unadulterated confidence. Management didn't just issue some vague, hopeful guidance. No, they put a hard number on the table. Core earnings per share for 2026 between $7.30 and $7.60. At the midpoint, that represents 17% year-over-year growth. This is a direct, authoritative statement of confidence that just flies in the face of the market's fear narrative. This isn't a company that's bracing for disruption. This is a company that's planning for acceleration. And this isn't just wishful thinking. This is their battle plan. They've laid out the detailed blueprint for how they're going to get there. They see continued double-digit growth in their stable, resilient businesses. They're projecting powerful, low-teens profit growth in the very advisory segment that the market is running scared from. They expect mid-teens growth in building operations. And underpinning all of it is the unstoppable force of demand from the hyperscalers. We're talking the big tech giants for data center sites. The growth is diversified, it's planned, and it is supercharged by the AI build-out. All right, the case has been made. We've seen the record numbers. We've heard the defense against the AI threat. And we've examined the massive AI-fueled opportunity in data centers. The bull case is strong, I get it. But the market isn't stupid. That sell-off was real money making a real bet. So let's put it all on the scales and let's render a verdict. On one side, you have the bull case, and it's built on a foundation of record financials, the strongest in the company's entire history. It's reinforced by the steel framework of the data center boom, which is a secular tailwind that is just getting started. And it's all capped off with strong, confident guidance from a management team that is executing at the absolute highest level. But on the other side, you have the bear case, and you can't just dismiss it. It's driven by a legitimate fear of technological disruption, the idea that AI will eventually erode those high-margin commissions. It's amplified by a tidal wave of negative market sentiment that took down the entire sector. And if you really dig deep into the analyst reports, you'll find it wasn't a perfect quarter. They missed revenue estimates in their global workplace solutions segment, and the assets under management in their investment arm also came in a little light. That's not nothing. The bears are arguing that where there's this much smoke, there has to be a fire, even if we can't see the flames just yet. They're betting the AI narrative isn't just a rumor, but the very first tremor of a much larger earthquake. The verdict from Iron Financial is clear. The market panicked. It became obsessed with a hypothetical long-term threat, a rumor about the future of brokerage, while willfully ignoring the powerful, in-the-moment reality of CBRE's financial strength. It ignored the company's prime position to profit directly from the AI build-out. This was an emotional, fear-driven reaction, not a logical, data-driven analysis. In our view, this sell-off represents a fundamental disconnect between perception and reality, and that spells a significant overreaction. So we've laid out the blueprints for you. We've tested the foundation with the reported numbers, and we've stress-tested the frame with the market's deepest fears. Now, the final call is yours. Do you believe the fear? Do you believe the narrative of AI disruption is a real crack that's forming in the company's foundation? Or do you believe the numbers, the guidance, and the undeniable steel framework of the data center boom that's being built right before our very eyes? That is the question you need to answer for your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.